And today I just wanted to revisit a topic we've went over a couple of times over the last couple of years is how much insurance do I really need? And I really wanted to focus on this one. A lot of people are, I don't drive very far since COVID. I'm not driving at all. I don't need as much insurance. Why am I paying for this? I just wanted to go through the most important parts of a policy for your auto, home, and some others. But let's start off today by just going through how much insurance I'm going to need. And there's basically a quick calculation you can do. The big thing is when we're looking at insurance, we want to make sure we cover your assets. We don't want to overinsure you, and we don't want to underinsure you, but we do want to make sure that we cover your assets and exactly tell you what's going on. So there's basically four categories to go over, and that'll kind of give us a rough number. And it doesn't have to be exact, just a roundabout, so that way we got a good idea in case we ever did get sued and we need to go to a deposition and provide these type of these facts. So the first one's going to be your house. So if you own a home, or homes, basically you're going to want to figure out. You can look at a Zillow estimate of kind of how much your house should sell for. So, for example, let's say it was a $400,000 house, and just an estimate of what we owe on the house. So, if you don't owe anything, then you have $400,000. Let's say you owed $100,000 on that house, so now all of a sudden we have $300,000. If you owe 2, 3, or maybe you're dead even at 4, and the house is worth 4. So we want to figure that up. If you have multiple homes, just do the same equation all the way across. The second one's going to be cars or one vehicle, 10 vehicles, how many it would be. Just like we did for the mortgage, we're going to basically want to get a value for those. So a Kelley Blue Book's probably a good idea on that. So let's say the vehicle's worth 20 and we owe 10, then you'd have $10,000 worth of equity. If you owe 20, you owe nothing, obviously it's 20, so on and so forth. So you want to do that for each vehicle you have that you currently own. Whether, even if it's registered to you, we want to make sure of that. So if you have 4 or 5 vehicles, make sure we get all of those. If it's just one, just figure the one. The third one's going to be investments. This is going to be, when I say investments, this also includes like checking, savings, but IRAs, cash value life insurance policies, 401k, 403b, pensions, you name it, anything that has like financial value for you for retirement or for currently everyday cash. Okay. And then the last one's going to be your annual income so if there's 2 of you in the house or 3, or if it's just one, you're going to want to take your yearly gross annual income. So before taxes, and then figure whatever 25% of that is. So for example, if you make $100,000 even on the year, 25% of that's $25,000. And then Arizona state law, there's a 10-year garnishment up to 10. So that's $250,000 worth of coverage there. Let's say, for example, and they can go after more. It's extremely rare to go farther than 10 years. But for example, they can go up to 10 years. So what we want to do is we want to add up all these columns. So for example, let's say we had a $400,000 house that's free and clear. So there's 400. We had another $25,000 worth of cars. That's 425. Let's say we made $100,000 a year, so that's $250,000 over the 10 years. So we're at $675. And let's say we had another $1 million in investments. So that would put us at basically a value of $1.675 million. So what we're trying to do is make sure we have enough coverage for $1.675 million. That way we can cover that house, we can cover those cars, we can cover your annual income, and things of that nature. So what happens in a deposition is you're basically going to have to present these, obviously quite a bit more accurately than we'll do in a quick synopsis, but proving everything that you have, and then going from there. So like let's say you got an accident, somebody got hurt, they had a personal injury attorney, they filed suit. Let's say you had $500,000 worth of bodily injury coverage for that one person. They came back at $892,000. The great thing about Farmers is they're going to provide an attorney for you at no charge. The best they can settle for is $700,000. Well, you only have $500,000 worth of coverage, so you are going to be responsible for the other $200,000. The question I always try to tell people is, I'm willing to do, like, if you make a decision where you only want $500,000 worth of coverage, but we have almost 1.7 million to cover, that's up to you. But there is that chance that if something horrible happens, that you could be on the hook for $1.2 million. Who wants to do that? Nobody I'm aware of, right? So I understand we don't want to overpay for anything, but we do want to make sure that the things we have and the things we've worked so hard for are protected. Same thing when it comes to the home. Let's say we had somebody doing some work on the house. They fell off the roof, and now all of a sudden they're hurt. They get a personal injury attorney. Let's say you had $500,000 on the house, and after everything's settled, it came in at 485. Well, Farmers is going to go ahead and pay that 485,000 for you. That's a good thing. But let's say it came in at 1 million. Do you really want to be on the hook for another $500,000 because you only had $500,000 worth of coverage? This is where a lot of people ask about umbrellas, and they can come into play. It's an inexpensive way to add quite a bit of coverage in case we do get sued. That's what umbrellas are for. That's your getting sued policy if something were to happen on that. All we want to do is, if the accident happens, and they do occur, is to make sure that you do not have to remortgage your house, borrow against your 401k, to garnish your wages and everything because you didn't have enough coverage because we were trying to save a few $100s. Once you get above a certain point, the cost of insurance is not overly expensive to go from, let's say, $250,000 to $500,000. It's not that expensive. The more expensive jump might be from 50 to 100 than it would to go from 100 to 250. Reason is it's not as likely to happen like a 50 to 100 jump, somewhere falling in that 50 to 100 where it is versus 100,000, 250,000. Like, the less likelihood for the insurance to pay out that money, the cheaper it gets. And the same thing when it comes to umbrella policy. It doesn't happen quite as often that the umbrella is going to get used. Therefore, you can typically buy, $1 million worth of coverage, somewhere between $250 and $500 a year, or we could buy, and just add a couple $100 a year on top of that for every additional million. So the cost, like I said, the cost of insurance is really inexpensive when we get to that point, just to make sure. I've had multiple people tell me I'd rather you have a bad day once the bill comes than I would have a bad year or life because we didn't have the proper insurance to make sure we were covered. And that's what having the benefit of an agent to do is you don't have to choose everything yourself. We can make suggestions, and then you can kind of decide from there on what you'd like to do. So I wanted to thank you for joining me on this episode of During Insurance Right. As always, if you could rate, review, or subscribe to whatever platform you're listening to, whether it be Spotify, Google, Apple, and all the other great platforms out there, I greatly appreciate it. And I look forward to seeing you on the next episode.